there is a decent chance the company that owns your dentist, your local vet, your apartment, and the brand of food in your fridge all answer to the same kind of owner. One you have probably never heard the name of. That owner is private equity, and it has grown into one of the largest forces in the economy. The industry is on track to pass $11 trillion in assets under management in 2026. The 10 biggest firms alone control more than $5.5 trillion, led by names like Blackstone, with over $1.3 trillion, Apollo, and KKR. For comparison, that top 10 manages more than the annual economic output of most countries on Earth. And yet most people could not name a single one of them, because private equity by design operates out of view. So what is it really? At its core, private equity is simple. A firm raises a giant pool of money from pension funds, university endowments, and wealthy investors, then uses that pool to buy entire companies. Not shares you can trade on an exchange, the whole business taken private. It runs that company for a few years, tries to make it more valuable, and then sells it, ideally for far more than it paid. The investors get their money back plus a big return, and the firm keeps a generous slice of the profit. That is the entire engine. Buy, improve, or restructure and sell. But the real mechanism that makes private equity so powerful and so controversial is how it pays for those companies. It rarely buys with its own cash. Instead, it uses a leveraged buyout. Imagine buying a house worth $1 million, but only putting in $100,000 of your own money and borrowing the other $900,000. Now here is the twist that makes it completely unlike a normal mortgage, and it is the single most important thing to understand about private equity. The debt is not placed on the buyer. It is placed on the company being bought. The business itself takes out the loans, and the business itself has to repay them out of its own cash flow. Think about how strange that is. It is as if you bought the house, and then the house itself became responsible for paying off the mortgage. The firm gets to control a huge company while risking only a relatively small amount of its own money, which means if the deal goes well, the returns on that small slice of cash are enormous. And if it goes badly, it is largely the company, its workers, and its lenders who bear the loss, not the firm. That asymmetry, big upside for the firm, most of the downside on the company, is the engine of the whole industry. Leveraged buyouts are the dominant type of private equity deal, accounting for well over $1 trillion of activity in a single year across thousands of transactions. Once you understand that model, you see why private equity ends up owning such ordinary things. The ideal target is a business with steady, predictable cash flow, because steady cash flow can safely support a lot of debt. That description fits dentists, veterinary clinics, car washes, funeral homes, nursing homes, apartment blocks, and hundreds of everyday consumer brands. These are not glamorous tech startups. They are boring, reliable businesses that people need in good times and bad. In a single recent quarter, private equity firms bought stakes in more than 100 American companies with at least 500 employees each. The takeover is happening constantly, one unremarkable business at a time. Now, this model can genuinely help. Fresh capital, sharper management, and real investment can turn a sleepy, badly run company into a stronger, more efficient one, and plenty of firms do exactly that. But the same debt that powers the model also makes it dangerously fragile. Because the company itself now carries the loans, it has to devote a big chunk of its cash to interest payments every month. Money that used to go toward hiring staff, maintaining equipment, investing in the future, or keeping prices low. That cushion is simply gone, converted into debt service. So if business dips even slightly, a bad quarter, a recession, a new competitor, there is far less room to absorb it, and a company that would have survived a rough patch on its own can be tipped into crisis. This is not just theory. Studies have found that companies bought through leveraged buyouts are many times more likely, by some measures around 10 times more likely, to end up filing for bankruptcy than comparable companies that were not. Because the model often favors fast returns and aggressive cost-cutting over slow, patient growth. The clock is always ticking toward the sale, and everything gets optimized for that exit. This is why people increasingly feel private equity even when they cannot see it. When a beloved local chain suddenly cuts staff, raises prices, or quietly lowers quality, there is often a new owner behind it running the same playbook. Load the business with debt, squeeze out cash, and prepare to sell within a few years. It is not villainy so much as the logic of the structure. When the debt has to be paid and the clock is ticking toward a sale, the pressure lands on exactly the things customers and workers notice most. Private equity is not a niche corner of finance anymore. It has quietly become one of the main ways ownership works in the modern economy, sitting between your pension savings on one side and the everyday businesses you use on the other. The next time a familiar company changes in ways that do not seem to make sense for customers, it is worth asking a simple question. Who actually owns it now, and what is the clock on their investment? The most powerful owner in your daily life is often the one whose name never appears on the door. Private equity works best when nobody is looking at it, which is exactly why it is worth looking.